Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights to help boost your trading potential. Coming up, the Fed's two-day policy meeting kicking off today. The market's eagerly awaiting key economic insights, rate signals as the central bank navigates inflation, but also consumer confidence challenges. Plus, we're going to take a closer look at BYD, that after the Chinese EV maker made some bold claims about groundbreaking charging technology. And is Carnival cruising to calmer horizons or heading for choppy waters? We've got the bull and bear cases on trading debating. The boys are standing by. That's all ahead. You're watching TD Active Trader Live. Got about 30 minutes of trading under our belts. Friday and Monday was a bit of a nice reprieve, wasn't it, from the selling pressure on Wall Street? The S&P 500, of course, fell into the correction territory last week. So we got a bit of a breather. We had green on the screen yesterday at the close and heading into the weekend. It's a different story today, as you can see, from yesterday's action into the close and at the open today, decidedly to the downside. Of course, now, as we were saying, we await the Fed decision tomorrow. They're expected to hold on rates, but it's all about parsing through the language and seeing if the central bank has any more insights than we do about where we could be headed when it comes to global trade tensions, the economy, and all of that. Let's take a look at the heat map beneath the surface of the S&P 500. Want to see what's on the move today and what's holding us back. And it looks like resumed selling in the tech space. You got NVIDIA, Google, Meta, Broadcom, all to the downside. Tesla giving up some ground again today, and Amazon down about 2.5%. So yeah, we're talking Mag 7 and some weakness there. I want to take a closer look at Alphabet, or Google. They're acquiring cloud cybersecurity startup Wiz for $32 billion, an all-cash transaction. Wiz will join the Google Cloud business once that deal closes. This seen as a bit of a catch-up for Google as their rivals Microsoft and Amazon, perhaps taking a little bit of leadership in the space. So that's a big number, isn't it? Billions and billions of dollars. Wiz only founded 5 years ago and now getting acquired by Google. I want to take a look at Peabody Energy as well. It is a U.S. coal producer getting a bit of a bid today despite the markets under some selling pressure. What's happening here? President Trump posting on Truth Social saying he's authorizing energy production using coal. Not seeing anything official on that front beyond that posting. Coal currently accounts for about 15% of the U.S. energy production mix. 25 years ago, back in 2000, that was 50%. And that's your market update. All right, joining us now for a more technical take on what is driving the markets, Hiran Amin and Jason Natick from our direct investing educational team. Here we go, another week. Thanks for being here, guys. We got lots to talk about. Hiran, you're going to start with a closer look at the small caps.
Yes, we're looking at the small caps, specifically the Russell 2000 index. I've got my chart pulled up. What I wanted to give everyone first was a view at the weekly charts, just to see how the trend's been forming. We saw for the longest time on this weekly trend, it was just chopping around. It had bounced off of this resistance, which is the 2,000 point level, which has been that psychological stronghold resistance, which is now support. So let's break it down and look at why are we looking at the Russell 2000. Well, because you said it, Greg, it's small caps and mid cap companies that are part of this. They're the ones that essentially fuel growth in the economy. And with recent sort of, airlines coming out and saying that, declining travel demand, retailers saying that there's lower consumer spending, this could be some big warning signs. Also, it is one of the first major indexes that is, which is very close to getting into bear market territory. And a bear market territory is defined as a drop of 20% or more from its recent highs. And we can see, I measured it out. So we can saw the recent high just after that election euphoria, which was at that 2466 level, came down over here. We just bounced off of that 2000 level that I talked about. So we're seeing some support bouncing off of this. We had some 2 green candle days over here, but we're about 19% on the low end of what it had dropped from its recent high. So this is one to keep an eye on, see if we can get it. If it's going to push, it could push up back to another let's say another 200 points up back to this resistance area. So this is a key one to look for. If it doesn't, and if it breaks below this 2000 level, that's when we need to be concerned, because that could spell out what the other indexes could also start heading towards that direction. One other thing that I did was interesting, and part of my sort of research was I wanted to find out how often does a correction, which is defined as a 10% drop off of its recent high, lead to a bear market. And looking at history, there's been 27 market corrections we've had since November 1974 is what this research paper looked at, including the current one we're in, and only 6 of them went on to become bear markets. Yeah, and the most recent ones are the dot-com bubble, the 07 financial crisis, and then COVID, of course. So we'll see what shakes out of that. So that's a bit of looking at that. We're going to turn our attention now to sort of the other side of this, looking at the metals. We often look at gold, but this is going to be gold's baby sister, silver. We haven't really covered silver, but silver's been making quite some moves as of recently. So we can see the chart here on silver. And what I've got is I plotted it from, this is the daily chart we've got pulled up. We're looking at this formation starting after that November high. Again, we saw it made those highs after the elections run up. It trickled down, and it's formed this cup and handle pattern. We love these patterns. And what I wanted to see was where could the possible extension or the next move be? So one of the things I've noticed is we did a measured move off of this pattern, and you can see the measured move is pointing towards silver hitting that 37.50 mark, at least if it does complete the pattern and the move does end up going. One thing that was also bullish for silver is we saw this downward trend pattern that had formed off of its highs. But one key thing was it broke off of the support off of the pattern, but also this downward trend pushing up higher over here. It's touching now what its previous high was at 35.07. So we'll see where it is. If you're thinking about what is silver's potential or high, well, way back in, I think it was back almost going back a decade, it hit around that 30, 38 level there. So that's another point. If it gets to the 37 point, we could keep pushing further if this inflation story is picking up and there's a macro backdrop, still there's a bit of a sour note or negative tone to it there. All right, so that's what we're looking at silver. Keep an eye on that and see what comes off of that. And finally, of course, we are going to look at our breadth indicator. We love looking at this one. This is the S&P 500.
How's the breadth, good or bad?
It's getting better. It's better.
The breath is getting
It was a bit smelly a couple of days ago, but we're coming on the up and up. So what we saw with the breadth was it actually hit the lowest point since 2021. And it went down as far as low as like the 32%. So essentially how you read this is this low was 32. So only 32% of the S&P sort of constituents were trading above the 200-day simple moving average. We've seen it nicely tick up there. What we usually want to see for a bullish case to be built again is 2 things. One is that it has to be over 50% for the majority of constituents trading over the 200-day moving simple moving average, but also the S&P itself, or the SPY, if you want to use the ETF, is also trading above its 200-day moving average as a price. So that's one to keep a lookout on. It's kind of swiftly bounced off of that, but this is a level. If it drops below 32, that could really signal more of a trickling effect there coming down there. So we'll keep an eye on that.
Interesting stuff. Keep an eye on that. What are you keeping an eye on?
All right, I've got Diageo. So this is a UK-based alcohol manufacturer, distributor, and they've got some popular names such as Johnny Walker, Crown Royal, Smirnoff, Guinness, amongst others. All right, so this is a bit of a...
I had a Guinness yesterday.
Yeah, I had
St. Patrick's Day.
So many people definitely joined you in that. So this is a bit of a good news, kind of bad news, 2 sides of the coin type of thing. So the first yesterday is St. Patrick's Day, like we got out there. So they were expected to sell, 333 million glasses of Guinness in the year, or in a day rather, which is 3 times their average. So, and they really like to play up. They're really active on socials. It's kind of a good brand following. It's distinctly Irish. People really like to kind of like partake in that beverage. But there's also a flip side to this. Like we know that the U.S. administration has threatened tariffs as high as 200% on European liquor. But then there's other things in terms of their sales. So let's jump in and take a quick look at the chart. Sales in terms of Diageo across the whole, they were down 6%, leading revenues to be down nearly 5% in the second half of 2024. And we can see that the stock is kind of on a very kind of long-term downtrend. And if we look even near term, we can see that trend has been continued. They tried to kind of peak out in the secondary trend beyond that the bearish trend, but it's been confirmed. If we even look at more recent long-term data, the simple moving average, that's just short-term average, is crossed below kind of the intermediate, and as well, that was also confirmed with the price crossing below. So all the joyous nature and the celebratory, Guinnesses from yesterday might not be able to make up for kind of what we're seeing in the chart and what we're seeing on the sales. So it's one to keep an eye on to see if the
drown your sorrows.
That would be the way that we could frame it. You're right.
The chart does not reflect it, but with my shepherd's pie, my wife's Scottish, right? So with shepherd's pie last night for St. Patrick's Day and the Guinness, it all
And the
went
Guinness
down.
Ale.
And very nice, but the chart's not reflecting my pleasure. Sorry. Thanks for that, gentlemen.
Yeah.
If you at home have a question for our team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, and you can find more information about all of our trading platforms under that Get Started tab. Find the one that's best suited for you by going through there. Whether you're a new or seasoned investor, TD Direct Investing has you covered. And once again, for the third year in a row, has been ranked as the #1 online brokerage in Canada by the Globe and Mail. Well, it's time now for Trading and Debating, gentlemen, and the stock of the week in the spotlight, Carnival Corporation. Before we get started on that, just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Options trading carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. All right, let's get back to the stock of the hour, Carnival. What made you guys pick this one to debate? Heron.
I'm becoming a little bit of a cruise after.
Are you a cruise guy now?
I think I'm turning
One
into
cruise
it. We
and
took
you
our
turned into a
first
cruise.
cruise and
Yeah.
it's got me hooked. So that's probably a start of the love story. Also, I was researching and in this macro sensitive environment, through finding that there's a strong value proposition because cruises tend to be about, the stat was 25 to 50% less than land-based alternatives, in fact. So we're seeing a bit more demand coming in there. So I thought
Please take advantage of the extra time you're getting here.
I'm starting my debate right now, out of the case. But.
And Jason?
It's one of those. Spring is certainly on the way, but maybe people are longing for a warmer destination, and we can talk you through there through our charts. So.
I've never been on a cruise, but my parents might be single-handedly keeping the entire industry afloat with the amount that they've been cruising in retirement. But
yeah.
Many of our parents.
Same with my dad.
I guess that's what it's all about. All right, so we'll get some time on the clock now. You each have 2.5 minutes to make your case. I've got the bell here, and I'm actually going to pay attention this week. I got distracted. Heron was so eloquent last week, I was lost in his words. And there was the fact that there was
big news in the market.
There was news breaking right in the middle of our debate that was right on top of our debate. But I've done some mental exercises. I'm keen now. So we draw off our hat as always. Jason, you got the bear case. Why don't you kick things off for us?
All right, so let's first start by maybe putting aside, grander, market and economic fears. You even mentioned off the top of the show how, airlines are kind of reducing their guidance based on broader economic fears. And so let's just say that maybe people are more worried about kind of putting food on the table and keeping their job as opposed to paying for their next Mediterranean cruise. All right, but Carnival Cruise Lines, it's unquestionably one of the largest cruising companies in the industry. Those extreme difficulties they saw due to COVID are certainly a thing of the past. Occupancy rates are high, and I'm sure you're gonna play that fact up, but that doesn't tell the whole story. There's three things that I want to hit on before we get into the charts. The first is costs. Okay, operating costs in 2024 raised by 9%. When you're just taking a snapshot at two big costs alone, fuel and employment costs, that's $126 million. We're not even factoring in other environmental costs that come along with running, especially when a lot of their cruises are run out of in EU territories and they have some pretty stringent regulations. Taxes, this is a bit of a complicated one. Many cruise companies are similarly, but Carnival is headquartered out of Miami, but incorporated out of Panama. And if the U.S. administration, they've been kind of beating the drum, if they can get their way, taxes may be coming, because right now these companies are paying little to no tax. And the last thing to talk about, discounts. You just mentioned it off the top there. Morningstar has done some research saying cruises are priced at a big discount. Typically 25 to 50% lower than their land-based kind of cousins, if you will.
1 minute.
1 minute, we're getting there. Okay, but with other costs that come along with that might not be attractive to newer cruisers, limited time in ports, extra costs on board, smaller cabins, and if you're like me, maybe a little motion sickness, I might not be the target audience for a cruise. But let's jump into the chart so we can get a sense of the picture that I'm trying to tell here. Now, the market has certainly been, this is, maybe you've heard this story, we've talked to a lot of companies, big run up over the end of the year. We've seen a big pullback through the early parts of this year. So the bump from the new administration is gone, and now we've seen some pullbacks, 36% off its highs. So we've talked, it's well beyond that 20% measure that you talked about earlier. A couple things that I've really noticed for myself is that we gapped up earlier in the year, but we've now, there's a very symmetrical gap on the other side. So we've gapped down below that point. So not only were we able to hold that gap, we were able to break down between new lows. And then looking here at from a pricing perspective, we've got some additional crosses that have identified to strengthen that down move below the averages and the average across themselves as well.
This one has sustained.
That is
right. Kieran, take us through the other case.
All right, you make a compelling case, Jay, but here's what I'm going to present with the facts on why I think there's a bullish thesis to be had with Carnival Cruise. First of all, with the market leadership. They have amenities such as like a planetarium on board of their ships. It is one of the largest, the world's largest cruise and leisure travel company, I will say this, and it carries nearly half of the global passengers. 14 million guests annually is what they carry. They have over 90 ships serving over 800 plus destinations when it comes to it. It's across 9 cruise brands. I wasn't aware of this, that it has 9 cruise brands across America, Europe, Australia, Asia, and some of the names that we might recognize are Princess Cruises, Holland, some of the bigger names, Costa Cruises out of Europe. Yeah, exactly. Love one of those. So they bring with them, part of what they do is that they bring economies of scale, brand recognition, and there's a stickiness with the customers once they get members. The second thing I'm also going to touch on is the booking trends. For 2025, they set records for advanced bookings at higher prices. They're not discounting these ones. I know you mentioned that, so that tells me there's demand. Cumulative advanced bookings for the full year is at all-time high, both on a price and occupancy rate. Nearly 67% of capacity is already sold at those premium rates there, so that's what we wanted to keep an eye on. Net income is expected to be 20% higher as well than 2024 at $2.3 billion this year, so that's what I'll talk about. Also on the efficiency side of things, they've got LNG-powered ships now, liquefied natural gas, which is considered the cleanest fossil fuel energy in the world, and there's 6 more fleets coming in 2030 as well. I'm going to reserve the rest of my points as well, but let's jump into the charts and let's see what the story's been telling so far. So if we look in the charts, what we see is coming off of 2023, they started going back into this uptrend, and that's what we recognize by having higher lows and making higher highs. Now, there's a few key things that happened. It kind of chopped around, but then it broke above this resistance. Over here, you can see back in September, it swiftly came down, but it's at a key inflection point, and there's a few bullish signals that have come up. One we saw on the weekly chart, we saw these 3 white soldiers, which is a strong bullish confirmation to go up, but also just coming off of these lows that we just experienced recently with the market sell-off, we formed a dragonfly doji candle, and this is usually a bullish reversal candle, so it just tells us when usually off of these lows we should see a bounce coming off of here. So this is the level I'm looking at there. If I'm just going to go back to the daily chart, this one's going to be a little bit more busier, but in the daily chart, what we're going to see, and I've got the Fibonacci's pointed up over here to see where
Ran out of time on the Fibonacci, and they pulled the screen down on you too.
I know.
Took the story away, even if you wanted to rush through. But you got time to counter now. You can bring up as many charts as you want during your counter. Jay, we'll let you jump in there first.
All right, let's start off maybe with a smaller time frame chart, because I really think it kind of fits my argument as well, because I've got a daily chart up here with the Bollinger Bands, not only with those crosses that I was talking about, we're now seeing it's crossed below the middle line. It's been continued to trade over the last number of weeks in the bearish zone. We've even had the down candle today. Certainly helps to show me that it's maybe going to be continuing towards the lower end. But I'm going to go back to a kind of a grander scale discussion around cost. We've talked about new ships that are coming, and they're trying to make them efficient. Well, these ships come with gigantic price tags. What was once looked at, 500 million, 900 million, well, that's pittance. We're now seeing ships in the $1.3 billion range. So
right.
These aren't drops in a bucket. And then and these are just to get these things out of dry dock. We're not talking about escalating food costs, labor costs, costs to put these things in the port. So there's all sorts of zeros that need to get attached to the end of that. And then we think about where's this money coming from? from? Well, at this point in time, Carnival is talking about a debt-to-equity ratio of over 300%, and they've got serious levels of debt that's coming up in the very near future. The research that I did shows me that they've got, $14 billion coming up by 2028 alone. So we've got serious pressures, and then we've all that are needing to be addressed.
So I'll say one thing about that, refinancing, of course. This is all strategies. This is part of the industry. This is not only exclusive to Carnival. Any cruise line operator is going to be debt laden. One thing about Carnival, I will say, is that they have prepaid $6.6 billion in debt so far. They've reduced the interest expenses. In fact, they refinanced recently, and they're now saving. They refinanced with a private offering of $2 billion, and now saving $80 million annually now just because of that refinancing there. They've been able to also, with the interest rates, you talk about big price tags, 100%. But because of the scale that I talked about, the economies of scale, and through export credit facilities, they have very competitive pricing. In fact, Carnival pays 3% or less on their financing of these ships of $1 billion price tag on them.
That 3% might not, you could say it's a low number, but when you actually break it down into what you're paying for the ship, but then when you're also paying to carry the loans and the financing, we're talking annually $1.7 billion of carrying charges on these loans. So it's, 3% might sound low for you and I to get a mortgage, but when we're talking about the grand numbers of these projects, so we're getting into
debt is always
zeros.
Serviced by cash flows. Cash flows, 5.92 generating cash flows from operations. That's what you need to service your debt. Here's what their forecast or guidance is coming in for this year. $2.3 billion, I said, on the net income. So they're growing that 20%. They're projected to even grow that even further in 2026. I'm going to talk about that. Also, the other thing that I wanted to talk about was what the background is, the macro backdrop with everyone giving like downward guidance. There was an analyst note from JP Morgan who in fact interviewed a few of the management companies of these cruise lines. They said they've seen no change in their booking curves or irregular patterns. No cracks in onboard spending, which includes high discretionary items like spa and the casino, and no change in cancellation.
Last thing about analysts,
look at that for the demand.
31% of analysts have the company rated as something other than a buy.
That's
not what I have.
The thumbnail for this one, I hope they use one of you guys with the boxing gloves, because you guys really scrapped it out there. Very lively indeed. Okay, we've had the debate, we've had the counters. Now, from the bear and bull perspectives, if you wanted to play the two options, we'll start with the bear. How could you do it? All
right, so you go through all sorts of different choices because there's not only just one strategy to accomplish the same goal. But when we're thinking about taking from a bearish perspective, I often gravitate towards selling options. But there needs to be enough juice in that trade to make the risk that you're taking on worthwhile. And examining the premiums for selling calls in this particular case, there just wasn't enough premium coming back my way. So I settled on a bit of a different strategy in going along with puts. The reason I settle on that because there's defined risk. I know it's a conversation we like to have around because I'm limited to the risk that I buy into the trade on how much I can lose. But the puts are relatively inexpensive to buy. So I have an opportunity to, with earnings coming up, oftentimes it's, you've got a lot of increased value in the contracts just due to volatility. But I've found that with this particular situation, that we can actually go out and buy a little bit more time and not increase your cost by a significant amount and still take a bearish stance at an affordable cost. So let's jump into the trade ticket. So we've got earnings coming up later this week, but if we go ahead and look out to April the 25th is what I've identified. I found in this particular case we can actually buy something that's slightly in the money. It puts in the money when the stock price has gone below its price. If we're looking at a $21 put, the reason I identified that is because the deltas happen to be higher on that than lower strike puts, because that means that I'm going to actually see increases of the value of my put quicker. So if it does move in the direction that I'm expecting it to, so they can see the delta here of 55 versus something just out of the money is going to be 40 and below. So I'm going to see quicker increases, and because it's further into the money, I'm going to see and actually the more time value as well, it's going to have less decay on that trade. So taking something thinking 38 days out is what in this particular case, buying a 21 strike put right now that's costing me, I could probably get that for somewhere slightly under $2 per contract.
You talked about limiting your risk. What is the risk?
The risk is what you pay. So if I can get these for $1.90 per contract, we're talking $190 per contract, and that even leaves me room to maybe size up on the trade. Maybe you're buying 5 or 10, whatever suits your budget.
Okay, possible way to play it, options through a bear. What if you were the bull?
Yeah, in the bullish case, so I just wanted to bring the charts up first to see where we could potentially see the stock go up from here. Based on the Fibonacci's that I have, I can go back to it now, of course. And this corroborates the story with analysts' ideas. The next sort of golden ratio zone is getting up to the $23 to $25 range. So that's kind of where I'm going to start with my trade. So the strategy that one could use if you're bullish is a diagonal spread. So essentially what we're doing in the diagonal spread, I'm just going to bring up my ticket over here and we'll queue up CCL, is we're going to be purchasing a long-dated call option. The one I'm choosing right now is just off of the current price, which is at the $20 strike. So I'm going out to the December for that one that we've chosen here. So we go into the December and we're looking to purchase this $20, which is about $375 is what the offer is right now. And we're going to be selling front month option, and I'm looking at the July expiry cycle over here. So that's roughly about what do we say, about 122 days out, 120 days. And I'll be selling where I think the next sort of resistance area could be, which is that 25. So essentially what this trade is we just want to minimize some of the costs for buying that long dated call by offsetting it with this call in July. So right now it's bidding about $2.90. So my cost right now to enter this trade is $290 in a single contract there.
That's what's at risk here?
That's what is the risk, yeah. So what's going to happen is essentially I need Carnival to stay above 20 to still be above water on this trade. If it falls below 20 as we get near to the expiry, we will start losing money eventually till it gets to zero there. Ideal case is if it goes above our strike price, we maximize the profit. So the profit in this situation could be up until July. If it goes past the 25, it's just the difference between the spread, which is $5 minus $2.90. So I'm making about $2.10 additionally as a profit.
Interesting stuff, gentlemen. Thanks for laying out the bull and the bear cases for Carnival. Just a reminder to our viewers, the debate was for educational purposes, does not reflect our personal opinions about the stock. Now, before we move on, Jason, you're going to take a closer look at a viewer question we got live during the show last week, asking how to put a OCO on your position. One cancels other, I believe.
Yeah, once again, acronyms in the business, we love them here. But one cancels other. It's part of kind of like a suite of conditional orders that we like to call them. The way I like to think about the conditional orders are great opportunities for you to help implement a trading plan. You can set predefined buy and sell points and have the system without using Active Trader, Web Broker, Advanced Dashboard. They've got these advanced orders that are there to kind of executing your strategy at predefined levels that help to take emotion out of the trade, help you manage the risk on your positions. But let me just show you in the platform how easy it can be to execute that. All right, so we're going to do this in two ways. We're going to create a OCO on a stock position that I own to exit it with a profit and loss, and then we'll go ahead and do the same with the option position that I created based on the trade. So first of all, looking at McDonald's, I happen to have 1,000 shares of McDonald's in my demo account. The Active Traders really made it easy to do. It's just point and click. You can see my 1,000 shares of MCD. If I right-click on the position, I want to bring everybody's attention to where it says Create Closing Order. Over on the right-hand side, it gives me closing strategies. The bottom one here is close with OCO order. So it's automatically drawing up. It's easy as that. It's up on the screen. It's got a limit order and it's got a stop order, profit target, and something set below. It's set just at the current price. So all I would need to go ahead and adjust the limit price on the top side where I want to go taken out if the stock goes in my favor, and on the downside, setting my personalized risk. Understanding as well the durations automatically defaulted to day in this. You'll need to keep the durations identical when you're across the strategy to ensure that it gets accepted. All right, let's go back now to thinking about an option trade. So I've got what happened to execute on the 20.5 puts here, but let's go use those as an example. So the same way that we're going to go ahead and get ourselves into the trade, I can go ahead and right-click on the trade in question. When we're choosing an option, you can notice that I don't get the two other choices. It's just creating closing with a limit order. So let's get that trade running. To get the second portion of the trade, the OCO added into this, what I want to direct everybody's attention to is the plus button in the very bottom left-hand corner. Access that. It brings up all sorts of different choices. OCO happens to be one of them. At this point, it's now selling to close. We can go ahead and just begin to craft the trade. We can have keep the top order as our limit, our price target. We can sell it if the put goes down, and then on the bottom side, we can use our stop limit or stop market, whatever works for me. So just as easy as that, Active Trader has got the tools to help this viewer, and hopefully they're going to be able to do that and get off and running and help themselves execute on their strategy.
Great explanation for the viewer, and we thank the viewer for sending in the question. If there's a stock you want to see our debaters go head-to-head on, you can send your suggestion to td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, and if you scroll down, you're going to find a tab that says Join a Live Masterclass. This Wednesday, 2 p.m., the team hosting an interactive session about TD Active Trader. It's going to explore the platform. And Jason, are you leading that class?
That's me. I'm up on tomorrow's docket, so 2 o'clock tomorrow. This is going to be focusing on researching within the platform. So a lot of the charting that you see here and I go through, we're going to be spending some time to get really hands-on with that. We're also going to be looking at some of the other tools like your watch list. We'll be looking at how you can tackle some of the fundamental datas and maybe even some scanning within the platform. So it's going to be a good one, and I'd recommend everybody join me tomorrow too.
And a little personal time with the stars of TD Active Trader Live. You can
go that way, sure, yeah.
You can go that way too if you want. Registration is required and is open now. All right, we're almost at the end of another show. Before we wrap up, though, lots of things happening. What is on the radar for the rest of the trading week?
So a couple of key waypoints to consider for the week ahead. Greg, you alluded to it already. The first one is FOMC meeting on Wednesday. So we're going to see maybe a little bit of calmness leading up to Wednesday, and then we might see some volatility come in. The big thing is there's no expectation of the target range, changes to it. But what's going to be important is the FOMC summary of economic projections, the SEP, which includes views on future rates, inflation, and unemployment. That's going to be closely scrutinized to look for any sort of dovish signals.
And the dot plot. Oh,
and the dot plot.
They say don't look at the dot plot. It's like, why do you give me a dot plot? I'm going to look at it.
Yeah, exactly. So that's what's going to be looked at. The other thing that's also happening this week, in fact, is NVIDIA is holding its GTC AI conference all week long. Today, in fact, Jensen Huang is going to be speaking at 1 o'clock and is giving updates on AI with details about their new GPU. We just learned about Blackwell. Well, now they've got something called Vera Rubin. So we'll see. We'll tune into what that's going to happen. That's going to probably have the semiconductors moving a bit. And on Thursday, they're going to talk about quantum computing. But the other thing that's got me interested this week is BYD Automotive.
Can they really charge an EV in 5 minutes?
Yes.
This is the claim. This is the claim.
Yeah, so here's the chart on BYD. So what I'm going to just preface this by first saying the symbol is BYDDF. This trades on the OTC pink sheets in the US market. So remember, this market is an unregulated market for our viewers. So they don't have stringent requirements and rules. So just be wary if you are looking into this company. But BYD, for those who don't know, is the largest EV producer in mainland China, the largest and the world's largest EV, which is the world's largest EV market, in fact, and it's the global leader there. This week is also, their competitors are coming out with earnings. XPeng, Zeekr, NIO is slated for earnings this week, and BYD will be reporting on Monday on their earnings. But with the big news that dropped today was that they've touted their new Super E platform is what they call it, and this consists of their Blade battery technology. It supports ultra-fast charging, and it's a high-performance electric motor. Here's the stats on this. They call it 10C theoretical battery that can be charged 1/10 of an hour. So within 6 minutes, you can get a full charge. It allows up to 1,000 kilowatts of charging. In other words, 1 megawatt. We talk about megawatts when we power cities. So that's how it gets it, and it can do basically for every 1 second, 2 kilometers worth of a charge. And then the motor has a 580 kilowatt motor, which is a V12 engine equivalent, essentially. So if you're
bold claims there.
Yeah,
bold
if you're a petrol head,
claims.
then this is one to look at. The chart's been moving significantly, quite on the run here. It bounced off of this level, off of the 40. We saw it's made a 54% run off of the lows over here, just coming into the start of the new year. And it's almost peaked at 52. In fact, it broke above its high. This is an all-time new high on the news that broke out today. So I'll be keeping a close eye on this one and see how that EV space develops and into their earnings next week.
An intriguing story. Jason, what do you got your eyes on?
All right, so I got just a side eye on FedEx. They've got earnings coming up after the bell on Thursday. Some people consider FedEx to be a bit of a bellwether for the economy, right? When you've got people shipping things into the country, or companies are more manufacturing things. Boxes and packages are flying around all over the place, right? So. But the trend for volumes in terms of FedEx shipping has actually been going in the wrong way over the last number of years, and we've actually seen some softening demand that FedEx has come out and said not only just from their ground but also their more lucrative express, where they've actually started to cut excess cargo flights in recent times. So it's something to keep an eye on, and we're listening for that. But looking looking at the chart in terms of the earnings, I've got a 5-year chart up here on the screen. It's been, there's been peaks and valleys. That's kind of standard, what you'd expect to see. But really over a 5-year period, we've not made any headway. But what we've pulled back to is a fairly significant pricing line around kind of around 240. And so, but what really interests me is we actually look at second level support. Is that there doesn't actually appear to be much down towards $200, which means that there's if the market isn't here, kind of what it's expecting here on Thursday, or if there's broader kind of global concerns here, then there's still some room for significant pullback in the share price here for FedEx.
All right, lots of interesting stuff there. Another great show, gentlemen. Always a pleasure doing this with you. I look forward to next week.
Thank you again. It's great.
That's all the time we have for the show this week, though. As always, investors should perform their own due diligence before trading. Thanks for watching.